Welcome back to DIY Finance Guy. My name is Sergey Modilevsky. Today's video is for anybody considering making the move from a variable or adjustable rate mortgage to a fixed rate mortgage. We're going to consider this question on the back of Canada's inflation report reading for the month of August, which came in below expectation across the board. The point of this video isn't to convince you one way or the other. In fact, it's just to simply present you with enough information to help you make an informed decision on your own. Let's jump right into it. More variable and adjustable rate mortgage borrowers are now in that predicament and are strongly considering making the move to a fixed rate mortgage. Now, their anxiety is completely warranted as they've watched the Bank of Canada complete 5 interest rate hikes to date in 2022. They've watched the overnight lending rate increase to 3.25%, and they know that there are more hikes to come, at least one coming up at the October meeting. They feel that sense of urgency because they've watched as their mortgage has increased and inched closer and closer towards what's called the trigger rate. That's a level at which their payment will no longer cover the interest expense owing with every payment, and the bank is actually going to demand that they increase the payment on what used to be a fixed or static variable rate payment. Now, many of these borrowers are considering abandoning that variable rate mortgage because they're hearing from other folks that borrowing rates could potentially climb to 6%, 8%, or higher. In that scenario, many of these homeowners would no longer be able to make the payment, and they'd be left with no other scenario but to sell the home. And in this particular buyer's market, as prices are sort of plummeting broadly, that's not an ideal experience and nobody wants to see that. So as a result, many of these folks are considering absorbing a much higher payment overnight by switching to a fixed rate mortgage to avoid the potential fate of an even higher payment down the road. There's no easy answer or resolution here, but let's start by getting a better understanding of what's causing interest rates to rise, which is inflation. So price inflation has been primarily on the back of rising commodity prices. We've watched them spike for over a year now, and these prices have been exacerbated by several geopolitical and climate events in 2022. All the information we've reviewed has kind of told us how we've gotten to where we are today. But let's take a closer look at where we're heading so that you can make a more informed decision when you choose a mortgage. We're going to start by looking at measures of consumer inflation. Then we're going to discuss a few reports from economists at Scotiabank and the Royal Bank of Canada about when Canada may in fact fall into a recession and what the peak rate may look like from the Bank of Canada. This week, we've seen a ton of inflation reporting for Canada. And while the headline number is quite high, still at 7%, there is a silver lining as across the board, all numbers came in below economist expectations. Let's start by looking at headline consumer prices on a year-over-year basis. That would be the Canadian Consumer Price Index report. The headline inflation report was released on Tuesday. We can see it here. We're going to look first at the year-over-year change. The actual report came in at 7%. The previous month in July had come in at 7.6%, and the consensus estimate was at 7.3%. So let's jump into it. So we can see that Canada's inflation rate slowed to 7% in August 2022 from 7.6% in July and below market estimates of 7.3%. We saw a growth in transportation costs continue to slow sharply from 10.3% versus the 14.4% in the previous month, and that was largely off the back of lower gasoline prices. Prices also decelerated substantially for shelter, from 6.6% versus 7% in the previous month. In the meantime, and most importantly, costs continue to pick up for food and household operations, furnishings, and equipment. Excluding gasoline, consumer prices rose by 6.3%, easing from 6.6% in the prior month. Now, I think that's one of the most important metrics to take out of this. So excluding gasoline, consumer prices rose by 6%, easing from 6.6% in the prior month. We're now seeing sort of a broader price deceleration outside of just gasoline. So commodity prices are coming down, but this is a sort of metric that'll ensure that inflation doesn't become more entrenched in the economy, especially with interest rates continuing to rise and more people and businesses affected by those higher borrowing rates. On a monthly basis, consumer prices also fell 0.3%. That's the first decrease in prices since December 2021 and the steepest since the start of the pandemic in April 2022. That is something not to overlook. Now, that was the 1 year, year-over-year headline inflation report. We just discussed the month-over-month reading. So we saw prices decelerate 0.3% compared to what economists had anticipated was going to be a slight decrease of 0.1%. Now, let's also look at the core inflation rate on a year-over-year basis, as this number removes some of the most volatile inflation items like food and energy costs. So the core CPI inflation rate decreased to 5.8% in August, down from 6.1% in July, but still close to the all-time high of 6.2% back in June. Now, it looks to us, at least at this time, that prices may have peaked back in June of this year, and they're slowly decelerating down, tells us that interest rates are doing exactly what they intended to do. The reason why core inflation is so important is the Bank of Canada has clearly indicated that they are closely watching that core inflation number, as it can remain much stickier for a much longer period of time than headline inflation. So this is the metric that economists really want to see stabilize, peak, and start trending down, which we're seeing for the first time in any material way in the month of August. This number will be closely watched at the upcoming report in October and November to decide if any additional hikes will be warranted when the bank reconvenes in December of this year. One of the most important metrics that stood out from today's reporting was the core inflation rate on a month-over-month basis. So the core consumer price index report in Canada was unchanged in August 2022, following a 0.5% increase in July. That might not seem like a material difference, but it certainly is. When you're pacing at 0.5% on a month-over-month basis, that means that you're annualizing at a 6% inflation rate. Here, we have a 0% rate of growth. And that's the first time in a long time that we've seen prices stabilize in this way. Consumer prices tell us a great deal about where the economy has been, but we also want to take a much closer look at where the economy is headed, because that's going to largely dictate what the Bank of Canada does moving forward, which is of concern for anybody that's considering the switch from a variable or adjustable rate mortgage to a fixed rate mortgage. They want to try to understand whether today's lower inflation readings are going to become an anomaly, the one-off, or are they going to become the trend of a decelerating rate of inflation in the months and quarters ahead? So we're going to take a closer look at input costs. So we're going to start with raw material prices. This includes everything from gasoline that goes into cars that affect transport and pretty much all finished goods, to things like fertilizer, which could affect the production of food. So this is where we've seen some of the sharpest deceleration in price growth over the last couple months. As we could see the sort of midterm trend, this is a 1-year chart showing back from roughly September of 2021, when we started to see some price inflation begin, and then that growth take place in the first couple quarters of 2022. We could see that in the last 3 months, we've really started to see those raw material prices decelerate in a meaningful way. And that's then going to work its way through the system from being a raw material cost to lower wholesale costs, and then eventually lower retail costs. And that's the sort of thing that eventually works its way through the chain up to consumer prices. So just a quick summary, raw material price index reflects the prices paid by Canadian manufacturers for key raw materials. Unlike the industrial product price index, the RMPI includes goods that are not produced in Canada. So because so many of our production input costs or wholesale costs come from other countries, this is a much more impactful metric for prices moving forward, specifically in Canada. We see that Canada is experiencing a much faster deceleration in consumer prices than what we're seeing in the United States and other countries as well. Next, let's have a look at producer prices. So we're going to start by looking at producer prices on a month-over-month basis. Producer prices in Canada fell 1.2% month over month in August 2022, following a upwardly revised 2.5% drop in the month prior. That marked the third consecutive decline in producer prices as costs continue to fall for energy and petroleum products and declined at a record pace for ammonia and chemical fertilizers. Costs also fell substantially for softwood lumber, and primary metal products retreated for a fifth consecutive month. On a yearly basis, producer price inflation slowed to 10.6%, the lowest since March 2021. compared to the downwardly revised 11.5% rise in the prior month. These prices are still egregious. I don't want to be misconstrued here. These prices are still egregiously high. But what we're trying to understand is, have we previously peaked and are we trending down? And what may cause these prices to potentially level out or rise again? This gives us an indication of what to look out for in the months ahead, and we can track those commodity prices through a bunch of public access websites. So as we can see here, as interest rates have risen, especially some of the more material hikes of 75 basis points plus, it has an almost immediate effect on all aspects of the economy, starting from raw materials that works its way into producer prices, and eventually we now finally in the month of August see it reflected in consumer prices on a month-over-month basis. And just to quickly summarize, so the producer price inflation measure measures a month-over-month change in the price of goods and services sold by manufacturers and producers in the wholesale market. The next thing I want to look at is a report from CMHC, the Canadian Mortgage Housing Corporation, reporting that annual rate of housing starts in August are down from July. Now, to be clear, housing starts are still at a pretty scorching pace, but they are starting to decline. Now, this is something we're going to want to watch closely in the months ahead, as housing starts tend to be a leading indicator of the unemployment rate. So what that means is that as housing starts decline, months later, the unemployment rate starts to decline at a more rapid pace as well. Now, we know that the unemployment rate in Canada has been declining for about 3 months. So we've seen 3 consecutive months of job losses in Canada, cumulatively totaling roughly 140,000 fewer jobs. We're going to keep our eye on these 2 trends. 1, do housing starts continue to decrease on a month-over-month basis between now and the end of this year? And what do we see out of the unemployment rate in these months to come? If these 2 metrics continue to trend down, between that and decelerating consumer price inflation, we're now starting to hit almost all of the metrics that the Bank of Canada has wanted to see in order to justify plateauing and eventually decreasing their overnight lending rate. I also want to take a look at commodity prices, which, as we had just viewed, are sort of a large driver of the deceleration in raw material costs and producer prices that we've seen. They're also a large contributor to the decreasing consumer price index reports that we saw. So let's start with some of the most important foundational input costs, starting with crude oil. Crude oil started a downtrend roughly in June of this year. It had peaked at around $122 and has trended down since. It's at about $84. Now, that's partially due to the economic slowdown in China. Obviously, there's a broad economic slowdown settling in across some of the largest economies around the world, but this will be one to really keep our eye on. We know that the United States has been quickly digging through their oil reserves. That's probably created a cap ceiling on the price of oil. With that now running a little bit lower, we're going to have to see how oil prices are affected in the months to come. You get the feeling that there could have been some manipulation, obviously, of how those reserves were used in anticipation of midterm elections coming up, and it'll be interesting to see if the price of oil rises as winter months approach. Next, we're going to take a look at natural gas. The price of natural gas has been swinging wildly as it's being largely influenced by the geopolitical events happening in Ukraine right now, obviously in other parts of the world as well, but we've seen natural gas prices in Europe spike to unprecedented levels. US natural gas prices are going to look a little bit different, but they've also seen an astounding spike. Right now, we're looking at the 1-year trend. If we dig a little bit further and look at the 5-year trend, you realize how absurd the prices that we're dealing with today in fact are. That being said, going back to, let's say, a year-to-date trend line, we could see that prices climbed from about roughly $4 in January. Then the war broke out. They peaked at around $9.75, and they've since come down. We're at about $7.80. There's no telling exactly where that conflict goes from here, but if we can maintain a price cap on natural gas, we can see that it's not going to have a detrimental impact on consumer prices moving forward. If we see that metric come down between that and a cap on crude oil, that is where we can start to see consumer price indexes come down in a material way because other categories are starting to decline more substantially. These are some of the commodities that have been coming down in price, but some of the ones to watch a lot more closely are the ones that are still rising. So they're stubbornly high, which are food prices. Food prices have been dramatically affected by drought conditions in food producing regions around the world over the last several quarters. And more recently, they've been impacted by the war in Ukraine, one of the largest exporters of wheat and other sort of input commodities. And as a result, we've seen the price of wheat spike in a really material way. So we could see at the start of the year, the price trend for wheat was about $768. The 5-year trend line, in fact, is much lower. So that increase in wheat price started back in 2021, but it got exacerbated by obviously the events in Ukraine, peaking at about $1,200, coming down since. But with some of the recent headlines around mobilization of the Russian army, etc., we're seeing wheat start to climb back up. Now, food prices have been a significant drag on consumer price indexes. There's no immediate remedy in sight to this problem, but obviously a resolution within Ukraine is going to be the big catalyst for a significant price reduction in some of these input costs like corn, wheat, and other relevant food inputs. So that'll be one to closely watch in the months ahead. In the second quarter of this year, consumer debt in Canada hit an all-time high. It's a 9.2% increase from last year, and this is on the back of a rising interest rate environment. Now, we actually know that since the second quarter, these debt levels have actually continued to rise. Another important metric that we want to look at is Canadian household credit market debt to disposable income. Now, this chart allows us to take into consideration how wages have grown over the course of this year, because they've certainly grown well above trend. But despite that, credit accumulation has outpaced that wage growth, and Canadians in the month of July have less disposable income than at any other point in history, despite the fact that wages have grown at a disproportionately high pace. That tells us a lot about where the economy is today and what sort of purchase power consumers are going to have in the months ahead, which is not a whole heck of a lot. Let's take a look at some other important metrics. I want to take a quick look at the 10-2-year Canada bond yield spread. To give you a quick synopsis, this chart compares the yields that are paid on a 10-year bond versus a 2-year bond. Now, typically, if you're holding long-term debt, for example, 10 years, you would expect a much higher premium to hold onto that because of the long duration of time. A 2-year bond yield, because of its shorter duration, typically would pay much less. But because of the environment that we find ourselves in, with central banks increasing rates at a pace in which to try to break inflation, despite the fact that it might cause a recession along the way, we see an inversion of those two yields because borrowers and the market are anticipating that at some point over the next 12, 24, 36, 48 months, the economy is going to take a big step back as a result of all these interest rate hikes. Now, the reason why this chart is important is that while it has not been perfect, it's certainly been an incredibly accurate predictor of future economic events. So the longer that a yield curve remains inverted and the deeper that inversion is, the more probable that we might see a significant downturn in the economy over that next 12, 24, 36, 48 month period. When exactly is pretty impossible to predict, but certainly with some of the other leading indicators that we have just reviewed, this does give us some indication of what may be to come in the months ahead. We're going to take a quick look at a chart out of the US. I'd like to give a shout out to Alf from the Macro Compass. I'll link his contact in the description. But what we can see from this chart is that bond markets have actually been remarkably accurate at pricing when the Fed is going to eventually cut rates. So it's not a perfect science, but if you look at this chart, you can see 5-6 occurrences where the market actually predicted and preceded the Fed cutting. So the market priced that by December 1998, they would cut. The Fed ended up cutting in October. The market priced that the Fed would cut by February 2001. The Fed ended up cutting in January 2021. They anticipated cuts by March 2009. The Fed ended up cutting in August 2008. Again, not a perfect science, but certainly as you can see from this trend, they've been very accurate. That brings us back to our Canada 10-2 bond yield spread, the deepest inversion that we have on short-term record, and it's now been in place and sort of an accelerating inversion for some time now. That'll be something to watch closely in the months ahead, in addition to all the other variables that we've already discussed in this video. So before we wrap up, I want to talk about what economists' expectations are moving forward. First, we're going to take a look at a note from Royal Bank senior economist Josh Nye, who spoke with clients saying, with policymakers pledging to do what it takes to rein in inflation, we think that soft landing is a distant prospect. Central banks are aware of the challenge, but only the Bank of England has been bold enough to forecast a recession. For our part, we think a European downturn is already underway as a continental energy crisis deepens. Canada, the US, and the UK are likely to see their economic contractions begin later this year or in 2023. For his part, Scotiabank economist Jean-François Perrault believes that a global recession is inevitable. COVID management measures in China, combined with the impact of inclement weather and weakness in the residential construction sector, point to the weakest growth observed since 1980, excluding 2020, which we know is the pandemic period. In Europe, the lagged impact of higher commodity prices, the war in Ukraine, and the impact of heat waves and rising interest rates are pushing major European economies into recession. With these major economic powers registering very weak economic performance, a global recession is assured. In addition, he believes that the Federal Reserve and the Bank of Canada are nearing the end of their policy rate tightening cycles. He expects the Bank of Canada to stop tightening after its policy rate reaches 3.7% in October, and forecasts that the Fed will stop raising its target rate once it reaches 3.5% in November. They anticipate that those policy rates are going to remain unchanged throughout 2023. While I was editing this video, the US Central Bank released its interest rate decision and economic projections. This release may impact the forecast from Canadian bank economists that I had just mentioned, so I think it's worth mentioning here again. The bank raised the federal funds rate by 75 basis points to the 3.25 range. They advised that ongoing increases will be appropriate in order to get above range inflation behind us. They're now forecasting rates to climb another 1 to 1.15% by year end, and for rates to peak next year at 1.5 to 1.75 higher than today. That suggests higher rates for longer. This complicates the forecast for the Bank of Canada, who's trying to strike the right balance in interest rates to curb inflation without derailing the Canadian economy. The Bank of Canada can't diverge too far from its US counterpart without reducing the value of the Canadian dollar. That would be essentially meaning that they would be importing inflation when they purchase goods from the US, but it would create more stimulus for Canadian exports. Monetary policy is hard work with no easy answers. The point of providing all this information in the way that I have is to give people a better understanding that rates typically don't go up forever. Interest rates are doing exactly what they're designed to do. By raising borrowing costs, you're reducing consumer demand. As supply chains increase production, the economy is able to absorb what supply is available without having too many dollars chasing too few goods, and we're seeing consumer prices decelerate in a meaningful way. More importantly, we're seeing raw material costs and producer prices decelerate at an even faster pace, an indication of what might work its way up to consumer prices in the months ahead. These events are not assured by any stretch of the imagination. The reason we have inflation in the first place is due to unforeseeable geopolitical events and climate change events. That could certainly continue into the future, and if it does, then that will change the forecast for interest rates. But the best we can do as consumers, professionals, or otherwise is to look at the information in front of us and do the best we can to make decisions based on that information. So, again, to be clear and reiterate what I said at the very beginning of the video, this is not intended to be financial advice, and I'm certainly not telling you what you should or shouldn't be doing with your mortgage. always speak to a mortgage professional or a bank representative and have them guide you based on your own unique circumstances. The purpose of this is just to present a reality of what current economic data looks like and to aggregate a lot of it and put it together for you to help form some direction of where the economy is headed. If you like this video and you appreciate this sort of content, I'd be very grateful if you hit the thumb and subscribe so you don't miss these videos in the future. If you think anybody else would benefit from getting some of this information, then please go ahead and share this with them as well. Thanks so much for tuning in, and I look forward to seeing